Welcome to the ALX Show, where we talk faith, family, and all things real estate. Let's get to it.
Hey, and welcome back to the ALX podcast. We're grateful for each and every one of you. Today, I've got Patrick here. Patrick's been an ALX team member for how many years, Patrick?
I'm almost 6.
Long time. I mean, since we started, right? A little background between Patrick and I is Patrick was a commercial banker, and he was one of the initial lenders of Conrad, which is a partnership that I was previously a part of. We did new development out in Dallas and Fort Worth, or redevelopment, and so that's how we got to know each other. And then he joined the team, and we started ALX, like you said, several years ago now. And Patrick is our director of investments. He does all of our underwriting. He does our portfolio analysis. He deals a lot with lenders, all kinds of stuff. I mean, anything analytical, Patrick's doing it. He's also keeps in tune with the economy, both locally and nationally, even globally, right? Just kind of whatever's going on, Patrick is going to know about it. And so he speaks a lot into where we're investing, why we're investing, at what level are we investing, just based on what's happening, and how it fits in our current portfolio and our current strategy. What am I missing, Patrick? Did I hit on it?
Yeah, man, that sounds way more important than I feel like would.
He's modest too, which is good. We like that around here. Humility. But anyway, today I thought it would be interesting. Something that Patrick does all the time for us is he underwrites. Patrick, quickly, what does it mean when I say underwrite?
Man, I guess just real simply, like just evaluating opportunities from whatever perspective we're looking at it.
Yep, exactly. So we got a deal. We don't know if it's a good or bad deal. In order to find out if it's worth pursuing, we underwrite it. You probably heard that term a lot. You hear that in lending. You hear that in insurance. It's just determining the value, also determining the level of risk. Underwriting essentially is another term for, I would say, just for analyzing. Yeah. We're analyzing the deal. We're taking it to a certain point to determine whether or not it's something we want to pursue or not. So that's what we want to talk about today, and just kind of our philosophy on it. We're looking at it from two perspectives. We invest, as you've heard on the show before, we invest in residential real estate. We also, though, are pursuing private lending to real estate sponsors, to residential real estate sponsors. So we look at underwriting in two ways, as an investor and as a lender. And I think the first place to me is when you're starting to look at a project and you're starting your underwriting journey, you have to have some way to measure it, right? You have to have something that you have to have some data, some criteria that's going to tell you, the value or help you make a decision of regarding the opportunity you're pursuing. So Patrick, talk about that. How do you determine? How do you set up a go or a no-go standard when it comes to making an investment?
Yeah, I think the best way to approach that is to develop a system where you can evaluate something really quickly. That's the goal, is how quickly can you say yes or no on something and find out what are the opportunities worth spending the most time on. And so from the investment operator owner perspective, just how quick, I mean, there are, when you start to evaluate deals, there's a million different opportunities out there. And so you can't spend time on all of them. You've got to be able to look at them real quickly and say, no, yes, I like this one. Let's go. So to, I guess, put a real example to it. This is the system, so to speak, that we've kind of come up with here at ALX, that we can look at any property and evaluate really quickly if it's something worth pursuing or not. And so, say for an apartment complex, most of everything that we look at is Class C apartments, maybe some, B minus stuff. Yep. And so, real quickly, we can get an idea of where current rents are. A lot of people use subscription programs like CoStar or Yardi or something like that to give them this information. you also can kind of bootstrap that and find real closely where rents are, just looking up what rents are leasing at online, that kind of thing. Or even just, when you do this enough times, you get a real sense of kind of what market rents are in the area. And so, across a market like DFW, rents are going to vary, but they're not going to vary too much. So if your goal is to ballpark it, you know that you can put a value on it if you have to, of where rents probably should be. The easiest way to do it is just take where current rents are and expenses. Like we will just slap a quick 50% expense ratio onto something. So for C properties, you're probably going to have an expense ratio of like 45% to 55%. And somewhere in between there, really depending on how utilities are metered. That's always the biggest driver. But just back of the envelope, 50%. So if my average rents are $1,200 a unit and you've got 100 units, that you could be making $120,000 a month in revenue if you're fully occupied. Then apply a 10% discount to that for vacancies, and then cut that in half, and that would be your monthly NOI. And so then immediately hey, here's where the current value would be compared to what the asking price is. And then step 2 is just saying, where can it go? That's the other piece you have to know is, here's where it is now. That's great, but where can it go? And that's just market knowledge of knowing where to be able to take rents.
All right, so I got you. So you take the broker's pro forma that they send you, right? And you just take their revenue, you cut it in half, and you submit your offer.
Yeah. Yes, exactly. That's exactly what the broker would want you to do. Yes.
Well, that's important because what you're saying is correct, right? I mean, we've done enough now to where. Well, let me preface this before I say this. The reason why you're able to say some of those things is because through your experience, right? You've done a lot of research. You've got a lot of experience. We can look at before we do. Oftentimes, just for a quick analysis, we'll say, well, what's a good expense ratio, and just slap it on there and just decide, well, okay, is it worth pursuing beyond this? Typically, we'll go a little bit further than that, right? Because we'll say, well, maybe rents will increase, or we look at the expenses on the line items and realize, hey, this is too much here. Based on our experience, it could be less than this, or we can find some efficiencies in there. But that it's important, I think, to note here to anyone that's listening and wants to invest in multifamily, is reach out to us, find someone that has experience looking at P&Ls, looking at pro formas, at multifamily pro formas. And I think it's great to have, just the general rules like, hey, yeah, 50%, 45 to 55%, which is accurate. You can go, what Patrick's saying, you can verify through a lot of data. But then also, make sure that you've got a level of expertise on your side, if you don't have it yourself, to confirm it, right? Trust but verify. So oftentimes you will find that those numbers do play out and are a good starting point. But you definitely want to take it beyond that and verify and confirm. And that's before what we're talking about before, what Patrick's talking about too, is before you have your condition assessment. So that's before you factor in, what kind of repair, then that's a property condition. That's a conversation for another day. But Patrick makes things sound really easy because he's got a lot of experience doing them. And what he's saying is correct. But you definitely want to push a little bit beyond just that general rule of thumb. Or you can be the broker's best friend and just submit on that data. It's up to you.
Yeah. Well, you bring up a really good point, Josh. I was explaining that really from like just being able to evaluate any property without having financials.
Right. Like, you have to be able to do that, right? I mean, because there's so many there's so many opportunities. It moves too quickly. A lot of people maybe don't understand. In residential real estate, things move very quickly. Now, once you have a multifamily deal under contract, it starts to slow down. But in order to win the deal, you've got to move quick.
Yeah. And if you've got a property that's listed through a broker, that's a different conversation than I guess what I was explaining, because you'll have financials, you'll have a rent roll, you'll have all the things that you can look at. The P&L will show you all the expenses. You can verify taxes, get insurance quotes, and all of that stuff. And, a great starting point of just kind of getting your toes wet in all this is just start reading OMs from brokers.
Yeah.
I mean, they really put together detailed stuff, and
They do. Yeah.
it's a great way to learn all of the ins and outs and the terms that they use. If you're unfamiliar with something like loss to lease, like you can kind of dig in and figure out what exactly they mean by that, and start to assess whether or not something can be viable for you.
Yeah. Great point. Great point. I mean, there's a lot of great multifamily brokers. We know several of them, and they are good at their job, and they do put together a lot of good information. So we joke around a lot because sometimes the broker represents the seller, but we're talking about pursuing something, so we're obviously on the other side. But there's several great DFW multifamily brokers that really do a great job. One thing though, I think that we need to hit on, or moving on, unless you got anything else to add there, Patrick, you ready to kind of go through this?
Let's keep going. Yeah.
Because ultimately what we've been talking about to this point is getting down to a net operating income, right? So we call that, everything to the NOI is above the line. And then you've got, additional cash flows that are below the line. Probably the most important one being what, Patrick?
Well, I guess I don't know if you're meaning CapEx or if you mean the loan payment.
Loan payments. I don't think you go to the ex-banker. I thought you were going to say loan payments. So, but it is. I mean, loan payment is the. I would say it's the one that you've got to take care of first, right?
Right.
So yeah, I'll let you take it from there. But loan payment. So how do we get there? Like, how do we know what that's going to be, and do we have the coverage? What's the debt service coverage ratio? I'll let you get into that a little bit. But yeah, what do we do from there? So we got the NOI. Now where do we go?
Yeah, you've got your NOI, and if you're looking at a property through a broker, they are going to have kind of set the table and getting you a soft idea of what financing in the market for that property looks like. And so a lot of it is verifying what they've kind of put forth and put out there. A lot of these brokerage houses also have in-house debt funding teams, and that's their goal, is to put potential buyers in the right debt vehicle for what that loan supports. And obviously a lot of that drives how investors feel about final pricing and what they can get out of the deal. And so there's a million ways to look at different financing options on each property. The multifamily world benefits from having government-sponsored agencies. Fannie Mae and Freddie Mac are a huge source of capital in the multifamily world that really props up the business and in ways that you can't really get in other areas of commercial real estate that are a lot more bank reliant, I guess you could say. And so they are a standard across the board underwriting that varies a little bit market by market, but once you learn kind of how they underwrite in those terms, you can look at any deal and know real quickly, hey, here's about what financing would be today, just by knowing where rates are and what the property's doing.
And that's another key to moving quickly, right? If let's sometimes those they have term sheet, a general term sheet, like I said, attached to the property information. But if they don't, then just keeping a beat on where the credit markets are, but then also having your relationships with those debt brokers or direct lenders is huge, right? I mean, because like we talked about, speed is important. So staying in the know on what the financing costs are and what the terms generally are, because I mean they've changed, right? We've seen that. I mean, we knew what they were, pre COVID, and then what they were through COVID, and then now what they've become in this historically fast rate increase cycle, which maybe we're getting some relief from soon, which means they're going to change again. So they're constantly shifting, and that makes it tough too, right? When you're trying to underwrite a deal, because without that stability in the credit market, you don't really know. We've dealt with this. You can go under contract on something and think that you've got the debt terms figured out, to find out in a short period of time, maybe even like during your option period, that debt terms have changed dramatically. I mean, we've seen, the index that people use, the commercial index, if we're going on perm debt or traditional debt, I guess is what we call is, the treasuries, and it'll line up with, your loan term, 5-10 years, typically 7 years, maybe. If you're going bridge debt, then, it'll be on SOFR, which is more directly related to the Fed funds rate. But we've seen, under contract, and I think even on one of our properties here recently, it was post inspection period. A lot of times you got to put hard money up in the front, on the front end of these deals. So, does it, the option period is great, but if you end up exiting during the option period, there's money on the table, there's money you walk away from. So, you hate for that to ever happen. Thankfully that hasn't happened to us. But I think in one deal recently, it was post option, and we were watching, I believe, Patrick, I think the 5-year, and how many basis points did it run up on us in a matter of 2 or 3 weeks?
A bunch. I don't know.
It was a challenge.
Yeah, it's a great point. I mean, you are the last, really almost since we've been in this, maybe our first year or two of buying properties, the treasury market was a lot more stable, and there wasn't a ton of unpredictable movement. But starting in 2020, yields started to jump really erratically, and really quickly. And so, a 50 basis point swing in 2 days, wasn't completely uncommon anymore. And that obviously can, half a point on your rate can change the outcome of your, the price you're offering on, and the free cash flow you're going to have, like, really dramatically. And, gosh, we probably, looking back, I think that when we were, first starting buying properties and evaluating, we get, soft quotes on a property that we're looking at, we're excited about it, and we think like, man, this is it, and didn't necessarily discount for like potential and change of terms or anything, and it ended up never really biting us, but it totally could have.
Yeah. Those are some long days, long nights. I mean, when you're walking through those things, we like to often, on the show, and just within our business, within our team, we like to talk about faith, and those are some faith growing situations, right? Because we're out of control at that point. There's one time in particular during the contract negotiation, right? We're through the option. All of a sudden, the debt terms have changed dramatically, but we've got money that's already gone hard, which means it's non-refundable. So if we walk away, then that money goes away, and it's a significant amount. These are expensive deals. So we're sitting here thinking, well, what are we supposed to do? Because we cannot force the seller, to negotiate with us based on these new debt terms. But the new debt terms throw all the economics off on the deal. So, and I think we've been in that situation, and anybody that's been in commercial real estate probably the last few years that's been actively purchasing can relate to this. It's not just us. I mean, this is industry wide, right? So in those situations, I remember Patrick and I talking, and my dad talking, and it's all talking together. Well, we gotta trust God. I mean, what else do we have here? And I think that we need, we can say, right? I mean, Patrick's here. We can say, I didn't bring this up before. He can tell me right now. Has God always been good? Has he always come through? We've always been taken care of.
Man, every time.
Yeah. So yeah, it's interesting sometimes, and I think God asks us to walk through those moments, right? Because it's very difficult to grow, to develop faith and strength of character when you're not facing adversity, right? But through those times of adversity and challenges, those are the times where we learn. Those are times where we get better. Those are times where we start to understand, how much of this really is out of our control, and where we really need to give over. Do our best. Don't get me wrong. We've got a part to play. I mean, and we need to show up with excellence and integrity, and do the best we can every single day. But then also when those things come in that we just can't control, it's like, you got to give those things up. Right? It's not easy to do. I mean, I say that, but I'm still freaking out. There's anxiety, it's anxious and losing sleep. So that's not really being super faithful, but we're working on that. But
well, I mean, we had to learn real fast too, that like to adopt the mindset of like, there's always a solution.
right.
When you've got $100 or $150 or $1,000, in earnest money sitting there that is non-refundable, you don't want to lose that. And so you've got to have the mindset of
Figure it out.
we've got to figure out a way to do it in a way that doesn't alter what we've proposed to everyone working with us on this deal. And there's got to be a way to do it. And there always has been. Man, in 2020, when we were going to close on one of our properties, all of a sudden, Fannie and Freddie started requiring those huge reserves for
That's right.
COVID.
COVID reserves.
I don't even remember what it was now, but it was hundreds of thousands of dollars.
Mm-hmm.
And it was totally refundable. And that was back when, raising money for a deal was hard enough conventionally without the extra burden. We just remember being like, man, there's always a solution. And it was a big trust God moment at the same time. And and it worked out, and actually worked out really well.
Yeah, it did. But yeah, I mean, gosh, I remember. Yeah, there's we've had lots of those stories, and then we'll need to get into that at some point. We need to have a show about those. I mean, because we could talk for a long time about seeing God's faithfulness in times where we're kind of at a loss, right? It's like, hey, we need God to show up. Like we don't know what to do at this point. We feel like we've done everything we can. If this is going to be resolved, if this is going to be successful, if we're going to be able to proceed, then God's got to show up. And he has. And that's something that, that's part of our story. And I think something we can get into more in the future. But I'd like to share it. I think hopefully that can be encouraging to people listening.
Yeah.
All right, back to underwriting quickly. Yes. One thing that I think people are probably curious about is an underwriting model. We built our own. Patrick built it. You can also go online. I think they're all good. I mean, I've seen several online. You can also get them through networking groups. But I think that it's pretty easy these days to find a model that you can tweak and customize, but just the general framework that you can use to be successful. You agree with that?
Yeah, absolutely. We never did that. You totally can. Most people do, and it's an easy and a lot less time consuming of a way to do it. I guess the analytical nerd in me has always enjoyed kind of building it on our own. And
you learn it too, right? You learn it that way.
That's why. That's exactly why. The same thing is getting as many reps as you can, looking at deals and underwriting deals. The same way that you absorb that and helps you learn it is the same thing that's true with your model. And if you put one together by yourself, you're going to know it so much better than just inputting whatever it's asking you to put in and your terms and whatever, when you've got to manually see like, the IRR is this series of cash flows and that's affected by these line items. To get there, like you really absorb what that means a lot more than just putting it into a model and giving you a number later. Not that I'm anti-model at all.
Well, it also helps you so much because you've got to present several times. Like if the underwriting is a green light and we're moving forward, well, then that's just really, I mean, there's a lot of work up to that point. But now the presentations really begin, both with your lender and then with the people that you're going to partner with on that deal, your passive investors.
Yeah.
You've got to present to all of them. And if you know the model inside and out, and then you built it for that deal, you can speak to this, Patrick. But how much easier then is it to discuss the deal with the other people involved?
Infinitely easier. And it's awesome for two reasons. One, like, the mindset that we should always have is no one should know the deal better than you. Not even the broker selling it. Like if this is your deal and you're going after it, No one should know it better than you. There shouldn't be any question that you shouldn't be able to answer if an investor or lender or someone asks you. And the way to get that knowledge is by modeling it manually. That's the best way to do it. We've done it before too, Josh, where we will study something and then try and, be able to know it. But if you've manually inputted, this is why having a red light, green light is so valuable, because it takes a little bit longer on the ones that you want to do, at least for us. And, but when you've manually input every unit on the rent roll, or, calculated what every floor plan is renting for today, when that question comes up, it's in your, not even like, oh, the A1 floor plan is averaging, 1020 a month. It's like, I've been in this rent roll for weeks, and I know that 10 of those are at 1100, but there's 5 of them that are at 800, and there's a real opportunity to move those up to catch up. And I mean, it just becomes ingrained in you, and it's secondhand. When you get a question about it, it just comes out.
Yeah, absolutely. And I've seen that with you so many times. And that just presents so much confidence, right? And you have to have that. I mean, one, you need to know that stuff. You need to be confident about that stuff in order to pursue the deal, right? I mean, that's where that piece comes from. Is there's peace in knowing the data, having the data like we talked about before. We need to have quality data. I mean, and we talked about how you go about getting that. But then having confidence and peace in what that data, those inputs are saying, and why they're saying it. What is it telling you? How are you interpreting it? And why? And by knowing it, like you're saying, by being that involved, then you can move forward with confidence in the project, which you need, because you're gonna get hit in the face with all these projects. You're gonna get. I mean, like, there's just, it is what it is. And when you're talking about asset management, like, there's stuff that pops up that you did not prepare for. So what you can prepare for, be prepared, because there's enough that you can't prepare for. And if you're dealing with the surprises, and you didn't have the foundation where it needed to be, then it's just going to be a mess, and it's not going to be any fun, and life's going to be miserable, and you're going to be stressed out and chaotic. So like we talked about before, what you can control it. Know the deal to the best of your ability. And that way you've got that foundation, and you can kind of course set on that. And then as things do pop up, and they will, whether it's market related or property related or management related, we've dealt with all these things, then at least you've got the foundation in the underwriting, in the initial business plan, which the underwriting is a key part of, to get you going and to keep you on course as these surprises, come at you.
And to piggyback, even when, during the due diligence or before you've closed on a property, when you know it really well and something surprises you before that, like there's going to be a much bigger CapEx item than you were expecting, and you've got to reallocate funds, or if debt terms change significantly, and you know the deal really well, on the front end that you've built in margin, either through not pushing your rents as high as you could have, or now maybe you can push them a little bit more to create some room, or you built in extra buffer on some expense costs. And so if an insurance quote is $15,000 higher than you expected,
that happens.
Over budgeted on repair and maintenance just to be safe, and you can pull back some of that. When you know it that well, and when you've had all the reps of knowing exactly what, expense line items should be for every property that you look at, then it helps you get through the challenges more easily.
Yes. Real quick, you hit on something that I think is incredibly important there. Let's talk a little bit about how do I remain aggressive enough, or how do I look at a deal and underwrite a deal aggressively enough to win it, but still being conservative enough, to not get in trouble, so my assumptions are not, so aggressive that all of a sudden something changes in the market, rent growth isn't what we thought it was going to be. You know what I'm saying? How do we, what's the right mix, the right balance of aggression and being conservative when we're looking at these properties? You do a great job of this. And I don't know that there's just like there's a formula for this. This is where I think experience really does play a major role. But what would you say to that?
Well, it's an art more than a science for sure. And it is, you've got to just know the deals that you are really excited about, and you've got to know when to push and when not to. So, and even then, I don't think it's ever wise to push beyond, to have scenarios or an outcome that is, really unlikely, or, something that's going to get you into trouble down the road. So the short answer is we have to look at a lot more deals because we don't get to the most competitive number on most things that we look at. And that can be frustrating too. It's a lot of
know when to walk away, right?
Yeah.
If you're being pushed to be more aggressive than you feel comfortable with, you've got to believe that there's a better deal out there that fits your philosophy, fits your vision, and know when to walk away, know when to pursue something else, which can be very difficult. We know that. But like you just said, Patrick, the one way that allows you to feel better about that is having a lot of opportunities. And we talked to Christian a little bit last time about that, about well, how do we do that? How do we go fill up the pipeline? But having opportunities makes saying no to an opportunity much easier.
Oh man, that's exactly right. When you can jump off of something and know that you're not going to be sitting around waiting for the next one, or that fear of losing out on a deal goes away because there's, plenty more in the chamber. Man, absolutely. Well, how do you feel, Josh? I think one thing that's been really good is that we've always been like, as best we can be, like really collaborative in our investment decision-making process, where all of us have to be on board. You think that helps with finding the ones that we want to get more aggressive on, and having, consensus around something that we like?
Absolutely. I know, and I believe I know. You've heard me talk about this probably more times than you'd like to, but it's a team effort. I know that I have blind spots. I know that we all have blind spots. I know that we all see things differently. We have different skills and talents, and all those things can be worked together to evaluate a deal. Like I know, like on this conversation, I understand the analytics behind the projects, the underwriting philosophy, why we do what we do. But do I think it's my best seat to be the one actually inputting the numbers and doing the analysis? No, I know that it's not. But I also know how important it is. And I've taken the time over the years to really understand what that data is saying. What can I learn from it? But I know that in order to make the best decisions, you, and in our case, in our teams, my dad, you guys are the analysts, right? You guys have that God-given skill set to look at deals and really see value and move the numbers around and really make sense of all the information in front of us. And that's incredibly important. And then we have other skills on the team that really help us to see, like, there's kind of, like you said, the art and the science to it. Different abilities in different areas of both the art and the science of deal evaluation. But walking the property, get a sense of the property, seeing like what the what kind of improvements can be made, and what's the potential of those improvements. What can we do on the marketing side? What can we do on the management side? Now we work a lot with third-party property management, but we've got good relationships with those teams now. So we really understand how they operate and what they can do and how they can improve things. So it's really it's a big picture. It's not, the underwriting is incredibly important. I mean, it's a foundational piece like we're talking about, but there's so much more to deal evaluation. The business plan, like really, having a good understanding and a clear vision around the business plan and how it's going to get executed. There's so much that goes into making a deal successful. So that's why, and like I said before, not anyone. I don't never met anyone that's great at all those things. I think you can be good. You can be proficient. You can be pretty good at all those things. But I'm thankful and grateful in our team that we've got people that are experts in each of those things. So it would just be completely foolish for me to not have decisions be based kind of on the committee approach or the committee style, saying, hey, let's all lean into our strengths. Let's talk about what we like, what we don't. Let's look for blind spots. What are we missing? Let's reach out to, because we do work with third-party property managers, like we said, let's go talk to them. Let's get lots of bids on the construction. We do a full physical due diligence. Let's talk to the team that's going to be running that. Lease auditing. I mean, there's so much that goes into it. So I think that in order to make the best decision, you need to have a well-rounded approach to doing that. And I'm grateful that our team has that. If you don't have that, it's out there. Like we built a team to address these different things. But if you're an individual and maybe it's important that you know what you're good at. I think that's where you start out first. But once you identify what you're good at, there's people probably, very close to you that can help you with those other things. So, I would never do a deal. I think it's also a biblical principle. You want to have like-minded people agree with you in what you're doing. So I would never pursue a deal unless I had the buy-in of the key people. And if I don't have buy-in from key people, Patrick, if you tell me, hey man, I don't think this is it. I don't think this is a deal, then that's enough for me. And I will say this, it has to do with your skill set, but it also has to do with trust that you and I have developed over many years working together. I know that if you don't like something, I trust and respect you enough to say, hey, that's it. Like I don't need to push you on it. We don't need to continue pursuing it. If there's something that's really causing you pause on this project, then that's good enough for me. There's plenty out there that we can all collectively get peace about. And I can't imagine doing it any other way. I wouldn't feel comfortable doing it any other way.
Oh man, gosh, same way. I've got, it's funny here. So hearing you talk about that, I have some like true weaknesses that are outside of, the spreadsheet world. Like walking a property and getting a quick mental sense of what the CapEx need is going to be. Like I have had to grow in like watching you guys, being with you guys as you do that. And I didn't have a good feel for that stuff at all. And then we go walk a property and you guys are looking up and you're like, oh yeah, soffit's damaged. It's going to be, 20 grand here for this piece and railing over here. And I mean, and that is so helpful to be able to take back to the underwriting piece to making sure that everything pencils out. The other thing that I thought of as you were talking about that too, is like, if this was, if it's just a one-man show with one-man skills driving things, like I'm also a terrible negotiator. There have been times like that I am jazzed up about a property and you have been like, dude, we've got to pull, like we can't get that aggressive. Like and that has always been correct in the way that I can get too excited about it. And there's also been times where on paper a property looks really great and we go look at it and you've always been a vibes guy and we'll go to a property and you'll be like, this isn't it. And same thing, I've got full trust that what you're saying is right, no matter how good the numbers look, that you think that's going to be a potential pain in the rear to deal with for 5 years. And that has probably always proven true too.
Well, I'm grateful and thankful that, we have the team that we do. And that's something that we'll always pursue is finding people that fill weaknesses along our team. And as the business grows, there'll be more things that we got to do. I know I'm limited in what I can be good at. So we've got to, identify who can step in and really like add value in areas instead of us constantly trying to improve on weaknesses. finding people that immediately cover those, and then really pressing in and developing our strengths. And it's worked out for us. Sometimes, you know, it's challenging, just like anything else, because, you know, there's a lot to learn. So you know, developing strengths, like we said before, comes through adversity and challenges. But what I'm talking about is knowing naturally and internally what you're good at, and then, you know, trusting that. And then when you're going through those challenging times, those challenging strengths, don't forget who you are and how you were created and your identity, and what you can do and what God made you to do. Even though the task at hand is difficult, the internal abilities and strengths remain. So those are the giftings that don't go away. So finding team members that represent different giftings and strengths, and then collectively as a group, everyone fulfilling their role within their strengths, you know, pressing forward and moving, you know, towards our collective goal, which that's what we're trying to do here. And I feel good about, you know, what we've done with that so far. All right, last thing before we jump off today, what would you say is just some good practical ways to keep up with the macro, micro trends, credit market conditions, you know, forecasts? Any quick, you know, Wall Street Journal is an obvious one, but that's more on a, you know, a national level. Anything you would recommend? I know you love the Texas A&M. I mean, for not just because he went there, but they do have they are a great real estate resource. What would you tell people? What should you follow? What should you keep up with? Just to, like we talked about, in order to move quickly, you have to understand where things are at any given moment. How do you do that? How would you tell other people to do it?
Yeah. So if you are just starting out and you're not going to do a subscription-based service like we talked about earlier, like a Yardi or a CoStar, they will be the easiest way for you to get a bunch of quick market data. We always bootstrapped it here and just kind of fell into, just through as much research as we can, as many different resources to keep ourselves in the loop with what's going on. And that starts, you know, big picture, macro-wise. Any forecasts about that stuff, you'll learn over time. Like, I'm not sure how valuable they are, other than digging in and really trying to understand what makes markets move, especially in the bond market. And that's always wildly different than what the headline is telling you is going to be moving yields, which has been a great discovery. Other data stuff that's really important. The A&M Real Estate Center is great. And I know you love trading economics for big picture stuff. That's another huge one. For, you know, asset or real estate asset specific stuff, again, read every OM that you can. It's got state, local, market data. They're going to be putting in all of your rent comps, all of your expense data. We used to just track expense data from every OM we pulled, and we just keep a running list of, like, here's all these properties' expenses, and kind of build our own industry standard book, which they've got out there for that kind of stuff. But we just kind of ended up making our own, and really just taking an interest in the things that drive the market and spending time to find what's out there. Gosh, I mean, I get a ton of economic data information from following the right people on Twitter.
Another good source, yeah.
It's great. All the
LinkedIn too, right? LinkedIn's got, you follow some economists on LinkedIn.
We don't have a Bloomberg
or
terminal, but I send you guys Bloomberg screenshots all the time.
Yeah.
And that's just from people that I've followed over the years who are always posting, you know, relevant things to what we do. Real Page is another huge one.
Yeah.
We've got a free blog that they put their analytical data in, and those are have been really helpful for us too.
Yeah, absolutely. Lots of great sources there. Well, if you are interested, if you're listening and you're interested in learning more about multifamily investments, single family residential investments, then we would love to hear from you. We'd love to talk to you. We're actively investing. We're also getting into private lending for the single family space. So if you're a sponsor out there and you're looking for financing on single family flips or developments, new construction, then we'd love to hear from you. We'd love to talk to you. And really, we just want to get to know you. The more people we can get to know, the better. Patrick, it was great talking to you as always, man. Appreciate your insight. Appreciate you. And we'll be back soon.
Yeah, man. That was a blast.